first of all, welcome to our web conference in the name of Monetative e.V. We are the German member of the IMMR, the International Movement for Monetary Reform. And with the beginning of the COVID-19 pandemic, we have started to host several web conferences in respect to the monetary and economic aspects of the Corona crisis. And today we're really happy to organize a rather international debate with the title Public Digital Money Revolution, CBDC, a different vision of money and banking. So that means that we will examine and discuss central bank digital currency, or short CBDC, which is of high relevance nowadays since the ECB has recently also published a new report on the digital euro. But in general, the digitalization of our society, as well as the developments of private cryptocurrencies and Libra and stuff, there are arising lots of questions about our money, our digital money, and its future. And so obviously, nearly all central banks around the globe are working on, or at least debating, CBDC. But the key question to us, or at least to me, is under what specific conditions and design principles is CBDC useful for civil society? And our expert today will give us his view about CBDC as a potential public digital money revolution. So a warm welcome to Mr. Miguel A.F.Ordóñez, former governor of the Bank of Spain, and of course, a well-known economist. Mr. Ordóñez will start with a presentation. Afterwards, our board member, Manuel Klein, will ask further questions, and then there will be time for the questions from the audience. So, Mr. Ordóñez, the stage is yours, and I'm really looking forward to your talk.
Okay, thank you very much. Well, many thanks to Monetative for inviting me to this seminar. I've learned a lot from Monetative, and I am delighted to share with you my thoughts on the CBDC debate. This is an interesting time. I never thought it could come so soon. Most central banks are studying the introduction of public digital money. In the European Union, the ECB has presented a good report on the digital euro for public consultation, and the Eurogroup has scheduled a first discussion on the digital euro for March next year. The explosion of reports, documents, conferences, the extensive and intense work of public and private entities is being a revolution. Now it is a revolution in ideas, but it will end up having effects on reality. It will end up transforming money and the financial system. This interest in CBDC appears now when just 2 years ago, the idea of public money accessible to all citizens was ignored by most central bankers, by finance minister, and by most of the academic economists. So before I deal with the current debate on CBDC, I will compare the conventional view of our monetary system with the view of those who propose to replace the current private and fragile money with a public and safe money which would allow the full liberalization of banking activities. The most serious problems of our current system are the lack of stability and indirect monetary policy and the lack of innovation and competition in the payment market. There are other problems, but these three are the most important. Most economists have held the belief that these problems could be mitigated by increasing regulation and state protection of banks. This explains why, after every banking crisis, the reactions of the authorities have always been to approve more regulation and more protection for banks. This happened after the great crisis of 2008. Most economists and those responsible for governments, central banks, and international organizations agreed on the diagnosis of the crisis. The market has failed, we all said. Not only leftist economists, but even liberals like Alan Greenspan confessed the error of having believed too much in the market. The result of this diagnosis was to increase state interventionism and protectionism. The volume of regulation multiplied with Basel III, new supervisory bodies were created, deposit guarantees were extended, and central bank increased the volume and variety of their interventions, reaching levels of interference in the markets that years ago would have been inconceivable. But in those years, a minority of thinkers emerged who proposed a different solution to replace the fragile money of bank deposits with a public and safe money issued by central banks. The cause of the problems is that private money is not safe money. If we had safe money, we would not need all the protection and privileges that banks have, and we could also eliminate the prudential regulation with which regulators believe they can prevent bank failures. From this different point of view, the diagnosis that the market was to blame for the great crisis was wrong. On the contrary, the problems are the consequences of a system in which the state, for many years, decades, even centuries, and in order to avoid bankruptcies and deposit runs, has increasingly protected the banks with all sorts of privileges and regulations so that citizens could use bank deposit as if they were safe money without fear. Until very recently, this idea of introducing public and safe money, what we call now CBDC, central bank digital currencies, was a quasi-clandestine idea discussed in small circles. Why suddenly the debate on the introduction of a public money has left the underground? In the first place, it's curious that this idea of introducing public money has not jumped from theory to reality because public authorities would have wanted to solve the stability problems of our system. It has arisen due to the inefficiency in payments. It has been the slowness, the cost of payment services, the exorbitant commission charge in cross-border services, the exclusion of millions of people who do not have bank accounts, and the lack of innovation in these services that has led the public money idea to jump from theory to practice. It has not been the public authorities. It has been the private initiative that is forcing the authorities to consider the need for such a reform. Facebook initiative to launch Libra has been an important driver of this debate, and we could also mention the Central Bank of China project and even the coronavirus. But whatever has led us to consider introducing CBDC, how do we evaluate it? We know the benefits of sovereign money that will completely replace fragile private money. It is what we could now call a full CBDC. But this is not what is being discussed now, but the introduction of a limited CBDC to prevent it from hurting private banks. Then how do we evaluate this limited CBDC from a public interest point of view? Certainly, the introduction of a limited CBDC will not imply a system change in its first phase. The conventional view will continue to predominate. Access of all citizens to public money will be limited to avoid its negative impact on commercial banks. Bank deposits, all those fragile assets, will continue to exist. The problems of systemic instability and ineffectiveness of monetary policy will subsist. All this is true, but the work that is now being done to introduce this limited CBDC is very valuable and absolutely indispensable to achieving a full CBDC. In the first place, much progress is being made in solving many technical issues, such as the choice of the best technologies, the design of architecture that give an adequate role to the private sector, the interoperability of the different platforms, or the different ways to ensuring the privacy desired by users, and many, many more. To get an idea of the many important topics being studied, I recommend reading Table 1 on page 11 of the latest BIS report. All this enormous expert work would have been equally essential in a project that proposed to replace all private deposit with public money, and therefore this limited CBDC will facilitate the transition in the future to a full CBDC. Most importantly, the limited introduction of CBDC has already served to spread knowledge about the benefits of public money to many experts and analysts who until now have practically ignored the idea of replacing the current system with a more stable one. And the mass media still barely dealing with digital public money are likely to start reporting it. The public consultation opened by the ECB should serve to complete these works with the vision of the public interest and the participation of civil society. I will end by saying a few words about the future of the financial system once this limited access to CBDC is in place. Despite the limitations that are finally imposed to protect the banks, when payments with public money are open to new competitors, banks will begin to feel their disruptive effects. These disruptions will have the positive effect of alerting banks that they will not be able to maintain all the privileges and protections of the state forever. And this should encourage them to transform themselves into entities that can function in a world totally subjected to competition. Today, banks have a high-quality human capital because they have been able to offer high salaries to the best. These managers must transform their entities so that without state aid, they can offer what users want. Citizens and companies will no longer be captive. They will no longer be forced to go through banks to make their payments. Banks now see the evil of allowing citizens access to public money. But at some point, they will realize that by giving up creating deposits, they will be able to develop other financial activities more profitable than this business. In addition, they will be freed from complying with strict regulations that would no longer have justifications since public money is totally safe. Those banks that do not adapt to what users want will disappear. But normally, some banks will adapt and survive. This has occurred in other sectors, air transport or telecommunication, for example, where technology and liberalization have radically altered the inventory of companies. The improvement in payment services will be the most visible effect because new providers will offer a variety of new services that we cannot even imagine today. Furthermore, the use of public money by all citizens will draw attention to the other problems in the current system. Today, people are unaware of these serious problems because the protection of the state has an anesthetic effect which prevents them from feeling the problems, because the objective of the subsidies and protection is precisely that depositors do not realize the vulnerability of private money. But the introduction, even limited, of public digital money will be a Pandora box that will increase the demands of keeping all money safe and removing unnecessary protections. In the specific case of the Eurozone, people will realize that we would not need a common deposit insurance or a common resolution fund, issues that are producing a confrontation between our countries, because the digital euro would not be fragile. It would not depend on the solvency of private banks. We would not need more capital injection to save banks, and monetary policy would not require massive interventions in financial markets because the central bank would not need to manipulate interest rates. Certainly, there still be problems in the financial system, but we will not longer have the problems that we have created with the many regulations and protections of the state. Now, after the failure of planet economies, in most countries of the world, both the production of goods and services and part of the financial system are already subject to market rules. But banking services are still heavily intervened by the state, and this is damaging growth and welfare. We all know that social goals are better achieved by correcting market failures than by suppressing the market. When this phase of introducing public money into our system ends, when all citizens can use a digital euro, the benefits of moving from the current system to a different, safer, and more liberalized system will be seen more clearly. And the debate, which is now focused on the introduction of public money, will focus on the design of the best transition formulas. If today we are discussing the introduction of a limited CBDC, tomorrow we will talk about the transition to a full CBDC. In any case, the path to that future, like everything in history and life, will not be linear. Most likely, the future will be, as the present is, an unpredictable mix of disruption and reform. Thank you very much.
So yeah, thank you, Mr. Ordóñez, and Manuel, your question.
Yes, thank you, Mr. Ordóñez. Thank you very much for this insightful speech and your views on that movement that is currently taking place. So my name is Manuel. I'm also part of the board of Monetative, and I've been involved in this whole topic with Monetative for a couple of years. I think many of the participants might know me, and I'm very happy that I also had the possibility to get in touch with you, Miguel, in the last couple of years. We were in good contact, and I'm happy now to jump back into your text, into your speech, and ask directly some questions to some parts of your speech here. So before we open up the questions to the audience, I would start by some questions here. So in the beginning, you focused on some problems of the current money system, and what has come up a couple of times is the ineffective and indirect monetary policy that you mentioned. So I was wondering, what do you actually mean by this indirect and inefficient monetary policy? So how can it be more effective under a CBDC system, especially under a full CBDC system that you described? And you also mentioned that the manipulation of the interest rate, of the interest rates as an ineffective monetary policy tool. And what, in your view, would actually be a better monetary policy tool?
Okay, well, I think the best way is to compare how monetary policy is working in the current system and how it would work in a public safe, a full CBDC system, as I say. Well, in a system where the money is public safe, the central banks will be able to carry out a direct monetary policy by delivering the money created to the citizens, either individually or to the state, as they are now, the central bank do it with the benefits, with the profits. It would not be necessary. It would not be necessary to force citizens to go into debt to increase the money supply, like now. Monetary policy in the current system is an indirect policy, in the sense that in order to increase demand from final agents, central banks intervene in the market in the short term to modify interest rates. It is assumed that if banks lower rates, banks would increase credit and indebted citizens would increase demand. And conversely, for citizens to reduce the growth of their demand, central banks increase interest rates and commercial banks reduce credit growth, and those citizens borrow less and demand grows less. And this has worked reasonably for the case, but in the last 10, 15 years, in the last 10 years prior to the 2008 crisis, in the period that we call the bubble, central banks were relatively successful in maintaining moderate inflation, but they failed because demand grew exponentially, mainly demand directed to real estate speculation. The indebtedness of citizens and companies grew spectacularly until giving rise to the banking crisis of 2008. Then monetary policy also failed when it tried unsuccessfully for the economy to recover after the crisis. Central bank cut short interest rates so that banks would give more credit. But it happened that citizens and companies were very heavily indebted, and they didn't ask for more credit. Later, the so-called quantitative easing was tried, in which central bank also started to intervene in the long-term interest rates, buying public and private bonds. This has worked somewhat better, but also with regressive effects on the distribution of wealth and with a very high level of state intervention in interest rates until they become negative. Then how will monetary policy work in a CBDC, full CBDC system? Well, in which all money is public and there would no longer be fragile money and so on and so on. Monetary policy can be direct and then it's more effective. It's not indirect. You go directly to the people or the state that demand. Then, and that's why, no? And it's true even that now, if we have the limited CBDC, that central banks could direct money injection to economic agents. But they will not do that if we maintain the current system, because this would mean reducing the business of commercial banks and we would have problems of stability. That's why we need that the whole system is a system of public, and we don't have the fragile banks, the fragile deposit banks.
Thank you. Very insightful. I want to go ahead within your text and within your speech, and then you focused after the problems, you focused on the introduction of the CBDC. And one point that I found really interesting is that you said that it has not been the state authorities itself that actually came up with the idea to introduce such a CBDC now. But you say basically that it has been the market and the private initiatives that drove the institutions to focus now on the issuance of such a CBDC. Well, what I believe is I see the main driver in basically the new technologies, which made it basically possible to transfer digital tokens from person to person, and especially, I mean, the emergence of new currency projects in cryptocurrency, but then ultimately also Libra. And then when these, we currently use claims on banks as euro money, for example, yeah. And when these claims on bank A that I hold need to be transferred from the balance sheets from bank A to bank B, then the system needs another asset, which is central bank reserves, to actually settle these transactions. And now with this new technology, it could be very easy to transfer the claims on banks directly between persons. So what I now wonder is, do you see a future for these private stable coins, so to say, because these are basically all this, these are the claims on banks, and they would then be tokenized and then transfer from peer to peer. So do you see a future for that, or where do you see a potential threat or a potential problem with these direct transfers of claims on commercial banks, which we currently use, but for which we need central bank reserves to settle these?
Well, I think there are two questions. I'm going to answer the first one, why I say that the was the market didn't fail the state. And this is the idea that I think is important to show that the system we have it has not been created by the market. It has created both a lot of protection and regulation. It's a creation of the state during a long period, because the banks had a lot of problems, and since the second part of the 19th century, we start to give liquidity injections, deposit guarantees with the crisis, etc., and so on and so on. And then it's important to know that because let me say one thing. I think Hayek, the economist, had very good. I have not agreed with many things, but I agree with some things. And one, when he was talking about reformers, said, well, it is better not to create something that is better if the market has created something, no? Because the actions of individuals creating many things that probably are not correct. He mentioned the languages. Languages are full of contradiction and so on. But if you try to do something perfect, that is Esperanto, that is not useful. That is not, no. And sometimes when I was studying the how to go from the current system to a public system, I thought, but I realized that really the creation of the current system had not been created by the market. And then just what we have to do is to liberalize and allow the market to provide banking activities. And then, but for this, it's important that the money is not fragile. And that's why the two things, the providing public and safe money and liberalizing banking activities is really very important. And what happens that the banks now have the two things. They create money and they have banking activities. And that's why one day Bill Gates said a sentence that I like very much, that was, we need banking, he said, Bill Gates, but we don't need banks anymore. I mean, we need banking and with full competition, but we need safe money. No, that is the first idea, and why I think the system we have now is very, very far from the market, especially in banking activities. The other question is the possibilities of new technologies, especially, well, the stable coins and so on. I would say that on technologies, I am a little agnostic. I mean, I am not, I think, well, technologies are very important. If we don't have technologies, we could not have a CBDC. The new technologies provide a lot of possibilities, and one of them is what you have mentioned, the tokens, the possibility to use tokens and instead of accounts, and so on and so on. And then that's why it's very important to accept or design some criteria that technologies should comply with that. I mean, for instance, let's talk about one stablecoin, Libra. Libra number one, the Libra that they launched in June or July 2019, was very bad from the and I think we should not accept Libra that as was designed. Why? Because it was based in deposit, fund deposit, and other assets that are not safe. And then the problems of stability, you are going to have the same problem that we have now with the banks. And in addition to that, they could create money. And then that is not tolerable. And then that's why I think one criteria should be all money should be public. We are not going to allow private money of any kind, stable, commercial bank or whatever. It should be backed 100% or be public money. Then, and it's one criteria. And the other criteria is nobody except the state through an independent body create money in the system. And then there are more public criteria that we should introduce in this debate. And that's why Libra number 2, the Libra that they launched during the coronavirus, well, they accepted that in a certain sense. Of course, we should be very cautious. And of course, we should know that big tech have a possibilities of dominant position of dominion, and I don't know how to say in English, no, dominant position, and many things, and we have to protect consumers and so on and so on. But if the money is public and they do not create money and they provide services of payments complying with this public criteria, well, if you provide public payments through the smartphone to 1,700 million people in the world, I think that is a good thing. If not, not. But and that's why I think technology should work, but they should work under the principles and criteria, thinking in that the system should be public and the rest should be privatized and in full competition. All the services, payments, lending, all.
Interesting. Yeah, thank you for that. Going ahead with your speech, you also mentioned the negative impacts of commercial banks by the issuance of such a CBDC. And I mean, we were debating about this inside of the Monetative a lot, because in the literature, most of the times the effect on the commercial banks are basically referred to disintermediation. So my question would be, what do you think about this term? Does it describe the potential effects on commercial banks correctly? And which effects do you actually see?
Well, I think that some critics of the CBDC and public money want to alert about this, what they call disintermediation. In fact, there is one thing that is true. CBDC public money is not compatible with private banks as we understand now. Then the effect, for instance, of a full CBDC now and change without any transition, a smooth transition, will be a collapse of all banks. I mean, this is not because they could not exist with the state protection and privilege that are based in that they provide private money. And they use this idea because it sounds, I think, very well, because, well, you are going to destroy the current intermediation. But what is curious, and I think we know very well after some working papers of the Bank of England, that private banks and commercial banks are not intermediaries. They are not intermediaries. An intermediary is between the saver and asks the saver to provide funds and the investor and so on and so on. But no, in the case of banks, the savers do not decide where to lend, to whom to lend. They put the money and the bank used to invest then, or creating that money through the credits. Then that's why I think it's a totally error and it's absurd, because if there is no intermediation now, how are going to affect and how are we going to disintermediate? I mean, I think it's really a misunderstanding of how the system works now.
I also see, I mean, that the literature sometimes discusses some points. So, for example, a potential balance sheet increase of the central bank, or that the refinancing costs of commercial banks might increase due to that, because, I mean, the banks will have to refinance a higher share of the loans that they will grant or the assets they will buy. But to me, also, this has nothing to do with disintermediation, especially when you use that term, which describes to at least most of the people something completely different. And those people that don't know how banks work, when they hear disintermediation, they directly feel that, I mean, banks are intermediaries and believe that. So I also think that this term is a bit of misleading.
Yeah. Sorry.
No, you can.
No, I agree entirely with you, and it's related with the other position that is we have now credit, investors have credit, and they are not going to have credit in the new system. But it is absurd because if you have a monetary policy that you give the authority to increase the supply, why? Well, not to have inflation, not to have deflation, no? Then that means that they are going to adapt the aggregate demand to the output potential. And then that means that the consumption and investment in the system will be correct. I mean, all will do what they want, consume, invest, and so on. But will be the market who decide who is going to have the credit and so on and so on. And of course, will be a lot of intermediaries because it's not thinkable that they will be done in the market like in a market of a city. I mean, one of the things that market provide is enormous variety and diversity of intermediaries. And no intermediary will be like banks now that say, well, you give your money and I will decide to whom I am going to invest. Then that's why, but it's curious because they say, no, we are going to have less demand. No, that is different thing. It's if you charge to an independent body monetary policy, the task of this independent body is increase supply of money until you don't have inflation and more than if you have deflation.
Interesting. Maybe one last point, and then we will open up the questions to the audience. But what struck me very much and what I found really interesting, and I think this is also part of your analysis in total about the current system, is at the end, you said that the disciplines of the markets do not really rule in part of the financial system, which are actually the banks. And can you please elaborate a bit more why you do believe that in the banking system, the rules and the discipline of the markets do not apply? Because I mean, there are hundreds of banks or thousands of banks that compete with each other for deposits and also loans. So isn't there not really a lot of competition already?
Well, I think that is more, I mean, one thing is that there are several banks does not mean that there is a full competition, no? And I think it's easier to see things if we see the competition in two activities of the banks, because when one sector have a lot of protections and have a lot of privileges and is heavily regulated, there is no competition there. If you have some producers that have tariffs, have quota, limited entry and so on, there is no competition. I mean, and this is the case. I mean, this is the case. You have and then why? Because it's not competition among the few that are in the model, but people that is outside and entrepreneurs that are outside. For instance, in lending, you see now that some platforms, P2P to lend and so on and so on. Well, I think it's a miracle that they provide any lending, because if you imagine, you put in their boots and say, well, my competitor, the bank, I have to go to ask people to give me money to lend, no? But the banks have warranted and a financing that are deposits without cost. I mean, it's incredible, no? And if I have problems of liquidity, I am not going to have any support, and the banks could. And the banks could access to the public money, because now there is a CBDC. Now there is a central bank digital currency that are the reserves in the central banks, but they are not open to any. Then it's impossible to compete with anybody that has those lot of that amount of protections. And in the payments is more clear. I mean, now all the payments should be done through banks in any moment. I mean, then that's absolutely, no? And then one of the good ideas or the good results of this limited CBDC is that at least for public money, we are going to give the possibility to have payment services without going through a bank. And we will see that small difference, that is not small, by the way, is very important, will provide a lot of initiatives, a lot of services, a lot of, because at the end, innovation is the best result of competition. And if you don't have innovation, if we don't have, you don't have competition.
Thank you very much for these last remarks. I think we can now open up the questions to the audience. So Simon, should we go first by first? So maybe Andreas Söderlund, he wrote that he has a question. So Simon, could you unmute Andreas so that he can ask a brief question?
Yeah, I did so far. So Andreas, is your audio on? So it seems like it's not working so far.
No.
Yeah. Now it's working. Okay.
We still cannot hear you. You are unmuted, but we cannot hear you.
So otherwise, I would suggest we go on with Martin Clancy, and afterwards we go back to your question, Andreas.
Hello, Martin Clancy here. Can you hear me?
Yes, we do.
Yes, thank you. I am from Ireland, member of the Green Party. Very briefly, we're in the Monetary and Banking Policy Group, and we're proposing, and our junior minister and our finance spokesman are pushing our own colleagues in government. We are in government at the moment, and pushing the finance ministers in Europe to allow Ireland to develop a sovereign digital credit system to supplement the present demand for our triple demand of COVID, climate, and uniquely in Ireland, Brexit. And we're asking the present participants and our august speaker to support us in that approach. A sovereign digital CBDC with the Irish Monetary Issuing Authority as distinct from the ECB. Thank you.
Thank you. Do you also have a question to Miguel Ordóñez?
Yes, whether he would endorse that approach, a sovereign Irish, in this case, as a pilot CBDC for the Irish Monetary Issuing Authority, which would be developed to issue that particular credit.
Okay. I think we can follow up on that one maybe with further information. Or Miguel, do you also want to comment on that?
Yes, because I don't know the proposal. You could understand that I cannot.
Can you not understand? You call for a digital credit system, but I'm asking for us to support a sovereign Irish digital credit system within the present Eurozone banking structure.
I think it might make sense to send further information on that to see whether Mr. Ordóñez is supporting that. I would continue now, maybe with the next question.
Thank you.
Thank you. Klaus, would you ask your question?
Yes, yes, I'm Klaus Kavert. I'm at the moment chairman of the Monetative board in Germany, and we are discussing also the possibilities of debt, what we call debt-free money. In the moment, central bank money is always is produced with a liability in the central bank balance sheet, but there's nothing behind this liability. There's no more gold behind. I think it's historically it's not no more necessary. So my question is: do you think that now in this moment, in this historical moment of introducing CBDC, would it be possible to produce it without having a corresponding liability in the central bank balance sheet? A little bit like euro coins now. Coins also don't have a corresponding liability in the balance sheet. What do you think about this? Would it be possible to have this discussion, or is it?
Well, thank you, Klaus. My view is the following. I mean, I think that debt-free money would be possible in a full CBDC system, in a system where all money is public and not private money like now. Then it is possible in the current system to introduce this kind. I think that theoretically it is possible. It is possible is what Franz Coppola and others talk about, helicopter money, and then you provide money without debt. But I don't think any regulator and supervisor and central bankers could accept that, because that is going to reduce the business of the commercial banks for the part that you are providing that. Because the main business of the banks is to provide money, creating credit and money. Then that's why I don't think in practical terms, not in legal terms, that it would be possible and so on, but I don't think that in practical terms central banks could accept that, especially in a moment like now that the situation of profitability of banks is very serious. I mean, it's not, we are really in a moment, and well, and if you follow the market price of shares of banks, really are under the value in books. Then that's why I don't think, I think it is possible, but I don't think it will be really.
But may I ask again? I'm talking about central bank money producing. What does it have to do with this bank? I don't understand the connection. I'm talking about central bank money.
The connection is that now most of the money is created through that. I mean, or direct is a business of the banks, creating credit on selling bonds and so on and so on. And this, if you need to amount the supply of money and you supply without that, without these current instruments, you are going to affect negatively to the business and profits of the banks. And that's why if you don't have the banks, I mean, in the system where you don't have the kind of banks we have now with all the protection, of course you could do all the intervention, all the injections of the money will be debt-free.
Thank you. Next question comes from Enrique Titos. So Enrique, could you?
Or otherwise, I would say we just give Andreas another try. And
oh yeah,
it works.
Sure.
And
sure.
Okay. Thank you very much, Miguel Ángel, for your speech. My question relates around the attitude of the ECB in terms of proactiveness in issuing a CBDC. You have mentioned in several occasions the implication of a CBDC in terms of financial instability. And as you know, especially Europe is a very bankarized continent. So whatever implication on the banking system will be major in a continent like Spain, as compared, for example, with the US or with China. So my question to you is whether you believe that the ECB should be taking a proactive role in approaching the solution, even if that is going to be painful and it's going to be requiring a transitory period, as you mentioned, or whether the ECB should be taking a sort of backseat role. That seems to be the attitude that is taking until the publication of the Digital Euro report. So this is my question.
Well, I think that, well, the ECB is being proactive. I mean, it's not what I think about that. I mean, all the statements of Lagarde, the testimony of Fabio Panetta in the parliament are saying that they are, well, working to have the CBDC. But obviously there is a conflict now on the effect of banks. It's obvious. And that's why we and ECB should be cautious in the time, the moment, and so on, when you are going to launch that, and with how many limitations and so on. Then I think it's a very delicate project, especially this limited CBDC, because you don't have a transition to the new system. But what could happen is that really, unfortunately, the situation of the banks are so bad that probably we could enter in the phase of design a transition to help the banks to stop being banks. I mean, instead of providing subsidies like now, general subsidies that end in, well, in demand for speculation and so on and so on, and then you could use probably less subsidies that we are using now to help the banks to giving up the deposits, be substituted and so on. I don't see, frankly, I don't see that in the near term. I think, and I express in my intervention, that I think that this design of transition will be once we have a limited CBDC in place, because it is important, because that the people, the population, the civil society know very well what is public money. And now it's very difficult to explain this. I mean, Monetative knows very well, and I know very well that it's curious that it's not easy to explain. But if you have public money, even in a limited amount, it will be easy. But let's say we hope that the banks improve and so on. But if banks continue to be in that loss of probability, it will be important to subsidize and help the banks, but to stop being banks. Because now, what we have done now during the COVID crisis, something that I think is, I agree entirely with what governments and central banks and ECB has done. That is to help the banks and to say, you don't have to make provisions, you don't have to introduce capital requirement, I am going to give you thousands of millions of euros, and I am going to change the system of remuneration, a lot of decisions to help the banks. And I think that is very wise, because you could imagine a banking crisis in addition of the COVID crisis. I mean, I agree entirely. In general, I agree with all the governments and central banks do during, as far as we have this system. I mean, I think it's important to help the banks and avoid problems of stability. But if that situation continue, it is possible that we should think how to use these subsidies to avoid the problems of systemic problems that we have. And then the banks could be intermediaries, they could provide lending, they could provide payment and so on, but not creating fragile money.
Thank you.
Andreas Söderlund seems to have some technical problems, and he sent us his question, which I will read out now. So his question was, should we really allow any private and surely profit maximizing actor to be a middleman in any financial activity? Money is an absolutely vital part of modern commerce and trade, and I see CBDC as a key in this. Wouldn't any private part, through their profit seeking and money making money from money through interest, percentage on sales, for example, in the end disrupt the actual function of money, which is to facilitate trade in the real economy and not, as today, used for huge profit and financial speculation? So yeah. Did you get that? Yeah.
No, I think that it's very important to separate and distinguish between money and payments, between money and payment services. I think money should be fully public. No question about that. And once, and that would happen immediately if you take out the deposit guarantees, the liquidity protection, because nobody will put their money in banks, in a private enterprise, and nobody will create a bank because it could not work. I mean, then that's why I think then money should be public. That for me is obvious, and that is the end. The full CBDC is the system, what we call before sovereign money or whatever. But payment services, I mean, how to pay is something that I think that should be entirely private, because there you have competition, and it's like the supplying of food or so is in the market. I mean, and what supermarket will compete with the small shops and so on, but you don't have a nationalized and public, or what is worse, what we have now, private but supported by the state, the banks to provide payments. No, then that's why money. I agree with you that money should be public, and you cannot enter the profitability and so on. The creation of the money should be guided by the idea that we don't have inflation and deflation, but not because I have demand where I can gain a lot of money like now. Then, but please, if we divide clearly between money and payments, we could at the same time privatize, in a certain sense, all the service, the payment and services, and then all payment providers will compete with clients to provide a lot of services and so on, as this happened in many sectors of the economy. Then you could have probably some intervention, because all these service providers could need the infrastructure general that could be provided by the state, by the central banks. Well, perhaps, I don't discard that they are one part of the system of payments that could be public, or public agreeing with the service providers and so on. I don't discard that. But in general, the connection with the people, the connection with the users should be private companies. And if you see any problem, you could subsidize or do that, because we have learned from the fall of communist countries one thing, that the worst thing is suppress the market. The market have many failures, but it's better to have market and correct those failures with targeted interventions. Not like now that we are giving subsidies and protections to private companies to provide payments and lending.
Thank you. Hans Florian, please ask your question. Try to make it as brief as possible, please.
Sure. Thank you, Mr. Ordóñez. I have the question, if we could have a money which is not in need of a monetary policy, which is working by its mere construction. Obviously, it needs to be a different type. Can you think what type it could be? Should be? Or...
Manuel, could you help me, because I didn't understand well the question, and probably, or you.
So Hans Florian, I think the question was if there could be, or if you, Miguel, could think of a money which is not, interfered by any type of monetary policy. So Hans Florian, do you mean, a K% rule, or?
Bitcoin, for example, no, that you have, is that the question?
Yeah, but not Bitcoin. Bitcoin is...
Well, Bitcoin or whatever.
A K% rule.
The CBDC.
I think that for a long time, I don't know if we will see, I think it's very difficult that one coin, one currency that is not public could be used as a means of payments. I see very difficulties, and we see with Bitcoins. You cannot pay with Bitcoins. Well, you transform in dollars or in euros, and you buy with dollars of euros. Then it's probably that in a long future, 2 centuries, or I don't know, it is possible to have a currency that is not public and is a means of payments. And that happens also in situations, well, in terrible situations like during the war and so on and so on. No? But in a normal state, I see that will be very difficult. They could not, those that create that money would not get to convert it in means of payment. It will be an asset, an interesting asset. And that asset will be important because you could avoid problems of inflation, for instance, because people could buy those assets going out from their currencies. But I don't see that those coins could be money, means of payments, I mean.
Miguel Hirota, so you also had a question or two. So
hello, thank you very much for your presentation. And I have 2 questions. First, a very practical question. Recently the ECB had issued a report saying that each national central bank, for instance, the Bundesbank in case of Germany, or Bank of Spain in case of Spain, and so on, should issue CBDC instead of the European Central Bank itself. Do you agree with that idea?
I did not see that idea in no report of the ECB.
Yeah, there I saw that.
I don't think.
According to my understanding, the European Central Bank suggested each national central bank, so like Bundesbank in Germany, Bank of Spain in Spain, and so on, should issue CBDC instead of European Central Bank itself. This is what I read.
I didn't see that. I mean, it depends what do you understand by the word issue. If it's creating, the only issuer of money in the Eurozone is the ECB. Other things is that if you could use the central banks to distribute, like now, no, physical money, but the issuance is a faculty of the European Central Bank. It cannot be. We will not seize national CBDCs.
Yeah. Well. Okay. Yeah. I was. And another question is that: do you think CBDC is a good argument for those people without a bank account to have their own bank account? Because even within the Eurozone, there are some countries where a significant number of citizens still don't have bank accounts. For instance, in Lithuania, only 83% of the population have a bank account. And in the Slovak Republic, in Slovakia, it's 84%, and in Greece, 85%. That means in those countries, between 15 to 70% of the population still don't have bank accounts. That means they are excluded from the financial service that we can enjoy. So in this, given this fact, isn't it important for the ECB and of course other central banks, especially in the so-called southern developed countries, to issue start CBDC as a way for to promote that kind of financial inclusion?
Well, I think that is one of the most important benefits of introducing CBDC, inclusion. I mean, a good design of CBDC would allow people to pay to others without having accounts in a bank. that is the great, idea of the Libra, the 1,700 millions of people that do not have an account and have a smartphone. And they could pay with a smartphone without banks accounts. And that is one possibility that should provide any limited CBDC that we design, because that is very important. In fact, is that if you now could give or transmit a message by WhatsApp from the point of any point of the world to any point of the world, completely free, no? Completely free, by the way, that is more complicated to transfer a message that transfer a number. I mean, if there is anything simple to use in a digital world are the numbers. I mean, and then that's why it's probably the most important. And it will be, as you say correctly, it's not only the developing countries that have this problem. In the United States are around 30 million people that do not have an account. Then that is not so important as in other countries, of course. But then I think inclusion, payments inclusion, would be one of the best benefits of a change, even if limited.
Maybe adding to your last points that you made, saying that WhatsApp is possible currently, but sending out money from A to B is not. I think blockchain technology has been part of the solution to that problem. And Helmut Rüdiger now has a question regarding that. So Helmut, you want me to read out the question, or do you want to unmute and ask yourself, ask the question yourself?
Yes, thank you for calling me. Good evening, and thank you for everything, for the interesting ideas. Mr. Ordóñez, as you said, the public does not even understand the actual system with, for instance, the difference of central bank money and bank issued money. But strangely, they understand, very often they understand blockchain, or they discuss it at least. So now for when Madame Lagarde announced CBDC, one of the first cry outs I heard was, our privacy is in danger. They will know everything about us, and this will come with blockchain technology. Now there are several questions. Well, there's first, is some blockchain technology, is it important, or is it requested for CBDC? Or can you simply go make CBDC with simple account systems as we had all the time? Now an account with the, at the ECB for every citizen. And my question would be, perhaps it's very complicated, but which would be the consequences for privacy and for data safety with the both ideas, a simple account system or a blockchain technology, CBDC. So thank you.
Well, I think that is one of the key questions that are being discussed today. When I told about the list of questions that have been debated in the BIS report, because is that, I mean, the question of privacy, the question of the kind of technology, the convertibility, the secure, that the payment is instant, that is resilient, that is scalable, that is interoperable. That is very important because different platforms shouldn't have the possibility to have captive the sectors, adaptable and so on. Then, I mean, there are those things that I cannot enter in discussing. What I want, I think we should give that to the expert. What we should decide at the level of public society, the public interest, is that the solution you give me is correct. I mean, in the sense that money is public and so on and so on. And on the privacy, I think that the question, and I am telling that I don't want to enter in these questions, but I am going to enter. In the privacy, I think that I see that there are possibilities to have part of the public money in tokens, probably with Bitcoin and others, but not all the public money, because it is also important that the fiscal authorities and the authorities that go against financing terrorism and so on, they have information and not privacy. Then, but I see this thing I read, but what is important is that we don't create systems like this one we have with private money, without power of the state and so on, that we do not create a system where there is no competition in provision. I mean, this kind of general principles. Unfortunately, Helmut, I specialize in general principles, not in details.
There's one last question from Virginia Hammond. So Virginia, maybe you unmute yourself and also ask your question.
I had a point of clarification. You commented a couple times, including at the beginning, that there's a benefit to this partial limited introduction of a public money, and that one of the benefits is it will push the banks to design their transition. What I'd like you to talk a little bit more about is why that limited introduction of public money needs to be debt money. As I understood it, you said that it needs to be debt money so as not to cause a collapse of the existing system. So I just want you to talk more about why the advantages and disadvantages, why that public limited money could not be asset money and not debt money.
Well, I think that, well, the public money is not asset money. I mean, it's not a promise to pay, it's money. I mean, and it's safe. Then because I see some that criticize this limited approach. Okay, but why I defend that we launch and we contribute to this limited CBDC? The main 2 points that I try to say is, one is that we are going to have public money. Now we don't have. The public money is not accessible to citizens, not to companies. And then we are going to go to a world that, even limited, they are going to know what is public money. And they are going to see that has not certain problems that have public money. And then the other question is that the other good benefit is that it's mostly probable that we are going to have a more competitive system of payment services, obviously, because it's what is the good part, I think, of private companies that see that the banks are doing very bad, and they see that they could fulfill the desires of the customers. And then I think having more competitive payment services with this question of inclusion and so on is very important. And the last one is that the idea that it is also contribute to understand what could be a full CBDC system, because now it's very difficult to explain that the save money is good, banks are creating problems or the system and so on. Then you open the possibility to do that. And that's why I think that, of course, but well, in general, I think the good revolutions are not the revolution, because revolution change everything that are done in an act, but smooth, step by step. In fact, I think our obligation is convert one revolution in one reform, and reform, because at the end we have a good system. And sometimes if you try to do revolution, you don't get what you want.
I think maybe stepping into this question, I think this question, but also the question of Klaus, kind of coincide, because I think the idea of both was if there is not a possibility to actually issue the debt, issue the money, the CBDC, basically outside of the balance sheet of the central bank. So say, for example, currently coins are basically issued from governance, from the finance ministry, and then they are bought from central banks. So there is direct seigniorage that is transferred to the sovereign state, actually. And it is not, when you look at coins, they are not accounted as a liability inside of the central bank balance sheet. So the question now, I mean, there was a lot of debate in the past as well, for example, in the United States, where people have demanded that the finance ministry actually coins a $1 trillion coin, because this would be debt-free money, so that the debts could be written down. And I think that is the bottom line, as far as I understand it correctly, of the question of Klaus and also from Virginia. If you see such a possibility that the central bank could actually issue this type of debt-free money outside of the balance sheet.
I didn't see those proposals.
Yeah,
I am not in position because I am thinking in the future, and in the future, money will not be a liability of central bank. Yeah. No money. Yeah. My idea. That's why I think, if you allow me, the description now of central bank digital currencies, I would say public issue digital money. And the currency will be issued by the public institution, but the public institution will be a register. It will not have to balance it. I mean, the money immediately created will go to the citizens. And then there is no liability. You decide the amount of money that you should create, and you put the money in the pockets of the individuals or in the budget of or mix or whatever, no? But that's why I have problems trying to understand this idea of debt, not debt, liability. And that's why I need time to answer those questions. I have not thought enough.
Clearly, I think it is a vision. So it is also part of the vision of Monetative, for example, to have exactly what you described, to have a register where this money, or the registry where this money is being registered, and then can be channeled from person A to person B, basically, to actually take out the money from any balance sheet, because it does not have to be part of a balance sheet. Yeah. I hear now from a couple of people here that Joseph Huber, you also might have a question. Please, go ahead with your question.
Yeah. Thank you. I guess I made repeatedly some mistake when trying to come in here in the chat. I was registering myself wrongly. Yeah, thank you for now. Adding to the question of whether a CBDC can be debt-free, surely it could be theoretically. But I think the act of introducing CBDC as such, so that will take up all the energies, and coming back to that idea, or implementing at the same time the idea for the monetary authority to separate the money creation from the banking operations of the monetary authority. I would say this is likely to be a bit too far-reaching at once. So coming back to Miguel saying the reality will be more a step-by-step procedure, because today, when the central bank is issuing money, it will always be a double entry of a credit claim and a liability, and that's the way it works today. And modern money theory tells us to think that formally it is debt, but in actual fact we need not. We would have to reinterpret the debt not to be debt. This is a bit tricky, but I guess they think it will be kind of what Keynes called a zero coupon, a perpetual zero coupon console. So kind of eternal debt which is not debt, but well, yeah. Miguel, among the many things you said, which I liked, there was in particular one formulation when you said that now, currently, we are discussing limited CBDC, and tomorrow, when the CBDC will be introduced, which I assume that will happen very soon in the coming 1, 2, 3, 4 years, then we will discuss how to make a transition from limited to full CBDC. And of course, I like that idea that very much. It's a very important perspective for us to have, because it will take time and we should not lose that perspective. But now I have, coming back to Virginia, I have a question to you, some sort of asking you for a kind of clarification. When you say limited CBDC, what exactly do you refer to? Do you mean simply the fact that we will have a system, a side-by-side system, when central bank digital currency, sovereign digital currency, will exist side-by-side in coexistence with continued bank deposit money, also in competition with each other? Is that what you understand by a limited CBDC, or do you refer to the idea that, how should I say, the public access to CBDC will be limited, or willfully limited, in a sense of there will be a selection of actors who will have access to CBDC and other actors who will have not. So, for example, the idea of limiting CBDC to wholesale payments and leaving out the broad public, the retail payment public, so to say. And I think possibly for technical reasons, they will start, so the process will start like this. But very soon, I guess that when CBDC will be in place, it will, for political reasons, it will not be possible to have a privileged access to it. It definitely needs to be, and I guess it will be very soon, a universal means of payment. And the question whether it will be limited, or more or less limited, will actually depend on the market demand for CBDC. And this will regulate that question. Let me say one thing. If we would have some minutes spared in the end, I would like to come back to that issue from the participant from Ireland, whether it is possible and reasonable to have a parallel sovereign digital currency in one nation. I do not want to talk it right now, but perhaps in the end, when we have another 2 or 3 minutes. Thank you.
Well, Joseph, on the limitation, no? On the limitation, I have the reason of limitation, I think, is clear. If you don't introduce limits, you give the possibility of take out all the deposits in private banks in seconds, because the digital money do not have the problems of storage, theft, and so on that you have physical cash. And you don't have to go make a queue. Then that's the problem. The problem is that I think if we want to go step by step, we need limitation. That is the first idea. The second is how. And there, I leave the expert the decision. No, I have two ideas clear. I mean, I think you should not limit the access, because it is important that all citizens and companies and so on access to this CBDC. And then you should limit the volume. And the other clear idea is that I think the most hideous idea to limit has been the idea of remunerate CBDC, to give the possibility to distinguish between the two remuneration, and even introduce the aberration, in my view, the negative interest rates. But not only negative, but positive. I think money is not risky. If you don't risk, you don't have right to a remuneration, because you don't have the possibility to lose. And then that's why I am totally against of the idea of introducing remuneration in CBDC. But you know, fortunately, I think that now most people is turning, no? And even the article of Panetta say, well, it will be only for certain tiers, no? The last article in VoxEU. Then those are my ideas. But it would happen, as you say, that even that small quantity and so on is going to political and so on ask for more. Then that's, I think, the solution will be to work and anticipate the transition. The transition and helping bank to make the transition. Because now that means what? Well, I see there are many systems. You remember the articles of Ben Dyson in the Times with Positive Money study these questions, or the article of Brunemeyer, no, saying the substitution with lens. But let's be clear, we don't have a good system of transition. We have not thought very much in the transition. Well, you have also the proposal of Thomas Mayer. I think that work is very important, is terribly important. And the only thing I say is that I don't discard that we use subsidies to help bank to do that. That is normal in structural reforms. When we decided to close the steel enterprise when I was Secretary of State of Economy many years ago in Spain, we decided to use a lot of money to help workers to adapt and so on and so on. Then it's not the transition to a free market, probably use it. And in this case, the amount of subsidies, implicit and explicit, that are, because nobody has calculated how much means the liquidity support, the deposit guarantee, and so on and so on. We have a lot of money to help. Then I mean that if we have that problem, that we see a more demand of more central bank digital currency, I think unavoidable to study a transition.
Thank you very much for this insight and this point. I mean, we are now 90 minutes into the talk, and I think all the questions have been answered, and all the questions that were inside of the chat have been answered. So what I would do now is basically wrap the session up, and formally again thank you very much for your time and effort to give your insights and also answer all of your questions, of our questions, and to provide further information on how you see this public money revolution, how you call it. So thank you very much, Miguel, from all of us, I would say. Yeah, then I would end this session now officially, and I would like to come back to Martin Clancy's question.